would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to a week-ending edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. I hope you all have had a great week, as always, of course. Of course, they all can't be fantastic. Some of them are going to stink a little bit more than the others, but hopefully this has been a good one. Apologies for yesterday's show getting posted later than usual. It was done at the usual time, and everything got entered and was all set to go out at the usual time. And at some point during the day, I discovered it wasn't out there, or it was out there. If you get to the show through Google Plus, or if you get to the show through the website, it was there. But for whatever reason, it didn't pop up on the RSS feed. And I went and looked, and despite the fact I thought I clicked all the things you're supposed to click, it wasn't even there as a thing. Apologies. I think it ended up getting posted right around 1 o'clock Pacific time. Hopefully not too late for you to take advantage of it for your drive home at the end of the day. If you would like to check in with me, feel free to do that at the website, therebelbroker.com. Click on Contact in the menu bar, and you can send along any ideas, suggestions, observations, or questions that you might have. If you'd like to get into the drawing for the $50 Amazon gift card we've been giving away every month, and we've done it 5 months in a row now. I think, are we at 5 months or 6 months? We're at a lot of months, giving away a lot of money. If you'd like to get yourself into the drawing for that next month, head on over to the website, therebelbroker.com. Click on the big red button, top of the page, titled Take the Survey to Support the Show. Use the same email address both times you're asked. Then answer a few demographic questions. And once that's completed, you will be entered to win the $50 gift card. And you're helping me grow the show. So thanks to those who have done it. Congratulations to those who've won. And good luck to those who are about to win. We've got a couple of little interesting news tidbits today relating to home sales, new home stuff. But we're also going to talk about the top 10 metros in terms of their performance for investors relating to rents and market levels for rentals. So we'll run down that list. Kind of an interesting list. A couple of familiar cities on that list, but the last time we did this list, a lot of these weren't on it. So it's interesting to see these shifts that happen. And some of these are not towns that have really been on the radar for much else. But I always find it interesting to review these numbers because these are areas that are where your rental yield is outperforming all these other markets that are defined as super sexy, right? And tend to be too dang expensive to get in on for folks who want to jump in and try to get investing. Here in California, when I get locals who want to talk to me about getting starting and investing, it's not easy to do. One of the most common ways that I see is folks pooling together with other investors and then doing whatever deals they feel comfortable with. The ones they usually try to do short-term deals so each party can pull their own money out and then move on to something that they can have for themselves. But I think that there's an interesting level of leverage that you can exert if you live in a place where it's a little bit more expensive to live, where you're able to bank a little bit more money. We're going to talk about some communities here where the median sales price for the first quarter of 2017 are under $100,000. In a couple of cases, a lot under $100,000, to the point where we're talking about having to come up with $20,000 or less, right, to come up with that down payment if you're going to go conventional. And I realize that's a big number for a lot of folks who live in some parts of the country. But when you live in some of the more metro areas and you're looking to get started and you want to get a 13% return on your investment or more, that sounds pretty good, right? Oh, so we'll cover those. But before we do, I wanted to hit a few of the interesting headlines I came across over the last day. The first one comes from CNBC, and the title of the article is "This is what's behind the severe housing drought." And they kind of try to explain it, and it's nothing we haven't really talked about. But again, it's another story that is focusing on the supply side of things. And they're not coming out and just saying it, that this is where the solution needs to be, and then suggesting solutions like we've done here. But at least it's getting more attention. Hopefully this will start a conversation at a much higher level. Will people start realizing the solution to because even in an article like this, that wants to go through and talk about how, you know what, the problem is we don't have enough homes. That's the problem. Once you come to that realization, you realize, well, then if you're really trying to help people, the dumbest thing you can do is push a system that throws more buyers at this particular problem. Let's see. There's some interesting numbers out of this. So I'm trying to just tease the numbers out of this article. Overall, it's fairly interesting to read if you want to check it out. As always, there'll be a link to this story in the show notes at therebelbroker.com. So feel free to head on over there and check it out if you like. The supply of homes for sale is now at the lowest level since the National Association of Realtors began tracking inventory 18 years ago. Kind of amazing, right? To think of this being the lowest point ever that this has been tracked. But this falls in line with the charts I've been sharing with you now for well over a year. Now, this is a national problem, coast to coast. Buyers are shopping this spring, and they're finding less and less in terms of the number of homes that are available. And what is listed is tending to sell fast. In Southern California, home sales in February were 14% lower than the average for the month, going back 30 years, according to the folks at CoreLogic, but prices were up, right? And we've talked about this before. These low sales do not equal low activity. This low volume of sales doesn't mean there aren't enough buyers. I think that's one problem that we have, is that when the politicians hear low sales, well, they naturally equate that with not enough buyers without asking a smarter question about the statistics. At least that's the excuse I'm going to give them. The bottom line is it's moronic to jump right to a conclusion that you need to create more buyers to the point where you actually want to start creating programs to create more buyers. So I'm giving them way too much of a pass on that. But the reality of it is, when you see sales going down and prices going up, that is the absolute indicator that what you have is a supply problem, and too much demand for that limited supply. According to Andrew LePage, research analyst at CoreLogic, activity continues to be constrained by the decline in affordability and the relatively thin inventory of homes for sale. But affordability is being negatively affected by the low inventory, right? It annoys me how everyone kind of sprinkles the fundamentals within some of these stories without coming out and actually saying it. And what they need to say is inventory is too low. It's a clear supply and demand problem, and the solution to our problem is more supply. He goes on to say San Bernardino County, which has the region's lowest median sale price, and entices many first-time buyers and others priced out of coastal markets, was the only Southern California county to post a year-over-year increase in sales this February. And again, what have we talked about before? That fits in exactly with our mushroom philosophy, where once you have noticed areas that have seen big demand, big increases in purchase price, and all that kind of wonderful stuff, folks start looking in the neighboring areas, the areas around where that's happening, and that's what's happened in that particular county. Housing starts, and this is another number that's mind-blowing. Housing starts are still only about 75% of their historical average. And if you sort of allow for the fact that we had a very crazy buildup at one point, it's even more of a shocking number. We're at this level of historic demand with historically low inventory. And that obviously combines to create this scenario where prices go nuts. Now, they also identify the problem here. The problem tends to be starter homes. They don't get into a whole lot of the details. They give you the general idea of what the problem is, and that is that builders indicate that their costs for land, labor, and materials are too high. So starter homes tend to be a less desirable option. because they just don't make enough money on them, without mentioning all the costs that are built into this relating to regulations and what almost equates to bribes or extortion from local communities, local cities and counties that will simply charge an additional fee for every home that builder builds. And of course, you end up paying it as a buyer. The builder doesn't just absorb that. That's people go into business to provide a service or a product that people want, and they expect to be able to make money at that, or they don't do it. There's no reason to do it if they can't achieve that goal. So if we were just to roll back the regulations relating to building just under the year 2000, right? Remember what we talked about. We did a show middle last year where we went over the regulations that have just been added from the year 2000 and realized that something that there was in the neighborhood of a 45 to 60% increase in the costs associated with regulations just heaped on since 2000. Imagine being able to cut the costs of producing a home by that amount, by reducing the regulations. Now, I'm saying to get rid of regulations entirely. If I had my way, we'd probably go back a lot farther and cherry pick a lot more older than the year 2000 that should go away as well. But even if we just rolled things back to the year 2000 in terms of what regulations cost builders, I don't see us building a single home that's any less safe than today or healthy or useful. But I see suddenly the math works out that a builder can build an entry-level home and have it actually make sense for them in terms of a time investment and what they expect as a return on their investment. In another article, new home sales increased to 592,000 annual rate in February. The reason is because those are the homes that are available. Basically the new home sales. They're selling everything that they build. At least in my marketplace, those things are going pretty quickly. But the good news is, if you were listening to the show a couple of weeks ago, we talked about how locally in the Silicon Valley area, I've noticed a general reduction in prices overall in terms of new construction, in terms of the volume of homes that are out there. But we are still getting ones that are at the 1.2, 1.3 million. But we had some here in Morgan Hill. I believe there were 8 homes in that development that were as low as 700,000, which is actually below average price in Morgan Hill. So that's a relief to some degree. I realize still that number's crazy for folks who live in other parts of the country and can't comprehend a place where it costs that much to buy a home. But at least that was an interesting trend. And at least on the part of some builders, clearly an effort's being made to address that need. And my guess is that they're simply doing it through building more. That particular development had a lot more homes in it than some of the ones that were higher priced. So they're trying to get a little bit more margin out of these, I think, by building more homes in the available space where they can. All right, next on our list of things to hit today, new home sales spike. Now, this is the spike that we saw in new home sales that we just discussed. It was actually a 7-month high, which again, I think just spells more relating to where the homes are coming from. There are simply just not a lot of people putting their home out on the market. We're seeing new homes tending to be the ones that are easier to get. New homes tend to not have a lot of multiple bids going on. You simply walk to the place where the new home is. You tell them you want to buy one. And the other thing is, these are also properties where you're oftentimes starting the purchase process for a home that's not even built yet. And remember, we were also talking about paying attention to the different phases of development of newer homes. If at phase 1, they are able to sell everything for the price they want, and then they're able to go to phase 2 and charge a higher price for the same floor plans, that's going to feed the frenzy of the builders to build more. So I think that that's a relatively healthy thing as well, at least given the numbers that we have seen over the past few months. And for those of you who've been listening for a while, you know what I'm referring to. If not, head on over to therebelbroker.com. You can do a search on previous shows. You can scroll through the shows by looking through the archive. There's also a great player right there on the front page where I think you can scroll through the last 50 shows. So, I mean, that's going back a pretty good way. I do 5 shows a week. So you're able to go back in easily 10 weeks and see what's been going on. And I try to title them so it's pretty clear on what we're talking about. So if those are things you feel like you want to catch up on, feel free to head on over to therebelbroker.com to check those out. So, in general, I'm not as negative on this data. I think it's really just interpreting this data, trying to figure out, where this might tell us we're going. Again, happy to see some news outlets starting to focus a little bit more on the supply side of things, not in as clear a way as I'd like, but you can see where the activity is. And for me, it still points to a market where if you do believe we're likely to face some challenges coming up, this might be a great window for you to look at selling the home you live in or liquidating that investment property. You've been looking for a window to do that. It's going to depend on what your local truth is, but I'm not anticipating that we're going to be able to sustain these high levels for long. As we see more buyers buy into this, or more builders buy into this market, and build more properties. And remember, we've seen permits going up. We've seen demand for wood going up. That's just going to feed the market more. And it wouldn't surprise me if we start to see a situation in the next year where things start to slow up a little bit. And you know what? I think one thing I've done in my life is decided, you know what? I'm not going to feel bad if I decide to make a market move where I didn't peg the high end, right? Now, there was a time in the past when I kind of played not the real estate market. I still play the real estate market. When I played the stock market a little bit, and I always kicked myself when I missed that high end of a stock by a couple of bucks or $5, or in the case of Apple, which is when I sold all my Apple stock once it hit 30 over a year ago, and felt really good about that because it immediately dropped, went below. It was 130, went below 100, and then went back up, and now it's up to 140 again. So, but I've given up on kicking myself over that kind of stuff. Still happy with having sold it at a very high point, but you kind of have to have that attitude about real estate. If you're convinced, based on the truth on the ground where you hold your property, that we're kind of in an unsustainable place, you feel like we're at a peak, all of the historical data is pointing to we might be at a peak. Don't feel bad about saying, it's time to back out. Maybe find myself something somewhere else. If it's your personal residence, that make it a little bit more complicated as you decide how you manage that. Because remember, you'd probably be buying in a similarly bloated market. So you have to decide what is the best way to leverage off of that. It may even equal, and I've seen some investors that will sell a property they're living in on the anticipation that they expect the market to change and become more affordable, but it's not quite there yet. So they go ahead and will rent something. And I think that's a reasonable thing to do. But it's, again, something you need to decide for you and your marketplace in terms of trying to figure out strategies. How do you move forward? And, this is kind of a stream of consciousness for me because these are all thoughts going through my head because, as I've mentioned on previous shows, I am in sell my house mode. And as an update, my kitchen is supposed to be done the first week of May, which is great news because, as you all know, I wanted to list the home middle to end of May. So I think everything is going to work out more or less on the schedule I was shooting for. What do? Do I go ahead and simply jump into another property immediately? Do I rent a property? If I'm convinced that what I'm seeing indicates prices will go down in, say, the winter months, maybe it's smart for me to wait for that to come along and try to take advantage of that. Of course, if I'm wrong, property values continue to go up and I find myself in a position where I'm renting and I may have to at some point decide I called it wrong and I need to just get into a property while I can. Or decide to move into an investment property, some other type, like a duplex, and then live in one half and rent out the other. So anyway, just apologies for that. It's really me sort of just letting it all fall out of my brain as I'm thinking about my options in terms of my own personal investments. All right, we're going to take a quick break, but when we come back, we're going to go ahead and talk about those top 10 metros for investors. Who knows? Maybe I'll find my next metro that I'm going to love. Or maybe it'll be a metro that surprises you and you want to turn your attention to it and see if it doesn't sound good for you. So don't go away. We'll be right back. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home. Or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right. Aside from hosting this show, I am also the owner broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com. soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. We just kind of ran down some quick data on some more popular media. I'm seeing a continuing mention of supply being the problem in terms of inventory issues. They will often mention it casually in the context of how we're all working real hard to increase the number of buyers or facilitate folks to buy, without really grokking that within their articles they're dropping breadcrumbs on what the real solution is without ever specifically saying, oh yeah, great, given what we've just said, this would be the solution. But hopefully we'll get there. Folks like me who are reaching out to a relatively small number of folks, I'm not really going to make a substantial dent. Hopefully it's a dent that helps you in your day-to-day in terms of what you're doing with real estate and hopefully the decisions you're trying to make. But I'd love for some much bigger voices out there to bring this home, because it's a pretty critical issue. And if it doesn't get changed sometime soon, I think it just sets the stage for a disaster that we've already lived through, and I don't want to do it again. All right, so let's go ahead and jump into this article. This is one we have covered before. If I'm not mistaken, I think this one comes out, I'm trying to think when the last time was we looked through this one. Is it quarterly that this comes out? This is the ATTOM Data Solutions Family Rental Market Report. The gross rental yield dropped slightly from an average of 9.1 in 2016 to 9 in the first quarter of 2017. Now, remember, this is comparing 1 year to what we're seeing in the first quarter of this year. So don't take that as a written in stone thing. It wouldn't surprise me if come the end of this year, we've seen for the average over the entire year something on par with 2016 or maybe even higher. Now, the way we get the data from this report, they analyze single-family rental returns in 375 U.S. counties, each with a population of at least 100,000, and sufficient rental and home price data, along with more than 6,000 U.S. zip codes with a population of 2,500 more, and sufficient rental and home price data. Rental data was from the U.S. Department of Housing and Urban Development, and home price data was from publicly recorded sales deed data collected and licensed by ATTOM. So that's where they're coming from. I won't give you, there's some other cute little quotes from these folks who put it together, but I think the real meat of this is the different communities that saw the highest levels of return for their investors, right? Because that's what you want. Now, here's a corollary to this, right? Now, this is absolutely aimed at those of you who are thinking, where do I want to consider investing as an investor? And given what I'm seeing on this list, if you're a first-time investor, absolutely make this list a place to start when you start thinking about where you want to invest. There are a couple of towns on here that blow me away in terms of how much of a return they got. The last time we ran this list, if I'm not mistaken, the community that was number one had a 14% return or a 13.9% return. And this actually, the top performers, the average may be down a little bit, but the top performers on this list are way beyond that number. So it's kind of exciting. And I think that since this is an average, if you apply some of the techniques we've talked about on this show, if you take your knowledge, crank that sucker up to 11 and more smartly pick the properties in these areas, that you could beat the averages that we're seeing in these various communities. So let's get into it and see what we can learn. Number 10 on the list is Springfield, Ohio. Now, and what's great is they're hitting right in the meat and potatoes in terms of the rental markets, right? What I've talked about before, desirability, 3 bedrooms, 2 baths. That's it. Everybody who wants a place, by and large, if you want to appeal to the largest number of people, 3 bedrooms, 2 baths, there you go. Fair market rent in Springfield, Ohio is $938 a month. And you're thinking, okay, well, that's not very high. However, the median sales price in the first quarter of Springfield was $84,000. Now, and they've had annual wage growth of 8.7%. But let's take this also to the next level. Let's go ahead and talk about our 1% rule. For those of you who are relatively new to the show, the 1% rule is what you're wanting to get out of a property is at least 1% of the purchase price of what you financed. So typically 80%, right? If you get an 80% loan, you want the rental rate that you're getting to be at least 1% of that number, the rental rate per month. So if you do the math on this, and if we assume $84,000 and we take 80% of that, which is $67,200, well, $938 is more than $672. That's a good thing. So just from that casual 1% rule, you're in positive cash flow on the worst performer on this top 10 list, if you're considering Springfield, Ohio. Now, next on the list is Sioux City, Iowa, Nebraska, South Dakota. Excuse me, I don't think I told you the percent. So it's in Springfield, Ohio at number 10, 13.4% return on those properties for rental income. In number 9, Sioux City, Iowa, Nebraska, South Dakota, 13.6%. 3-bedroom fair market rent is about $1,000. Median sales price in the first quarter of 2017 in that area was $88,500 with annual wage growth of 8.5%. The 1% rule applied there. We end up with 80% of that average being $70,800, which gives us $708 per month in rent would be the minimum you'd expect to be positive cash flow, and you're $300 a month over that in Sioux City. So the 1% rule, again, really flying high for us in terms of that town. Now, next on our list, Dayton, Ohio, with 13.8% being the return. And again, remember, these are the averages in those areas. So you got to figure there are some folks who made less and some folks who made more. You apply the rules we've talked about. You jump through the mental hoops that we've discussed. I am convinced that any of you out there could make more than that 13.8%. Okay, so 3-bedroom fair market rent in Dayton, Ohio is $1,090. The median sales price in the first quarter of 2017 was $95,000, and the annual wage growth was 5.6%. Applying our 1% rule gives us $760 a month, just in round numbers, what we would expect to want to get in rent if we were to purchase that price with a standard loan. And of course, rent is at $1,090, which indicates we would be doing well in terms of positive cash flow. Next, let's go with Pittsburgh, Pennsylvania at number 7, showing a 14% return on investment. 3-bedroom rent at fair market level for Pittsburgh, Pennsylvania is $1,106, and median sales price in the first quarter of 2017 was the same price as in Dayton, Ohio, $95,000. So again, $760 would be the minimum we'd want. We're getting $1,100, so just a really good return on investment for that community. Next on our list at number 6, Philadelphia, Camden, Wilmington, Pennsylvania, New Jersey, Delaware, Maryland. I hate when they do that. That's got to be a gigantic area, right? Or am I not right? Is that not huge? 14.1% is the return. 3-bedroom fair market rent is $1,515 with 5.4% wage growth. If we apply our 1% rule to Philadelphia, the whole list of cities they list there, we end up with $1,030. And $1,515 is the average, so you're definitely positive cash flow. Not as much as we were seeing in Pittsburgh or Dayton, but still very good. I think we were seeing about the same as Dayton, but better. Pittsburgh was better. Next on our list, number 5, Toledo, Ohio is coming with 14.5%. 3-bedroom fair market rent there is $1,066. Median sales price in the first quarter of 2017 was $88,400 with 7.4% annual wage growth. Applying our 1% rule, we end up with $707 a month as our minimum expected rent, and of course it's at $1,066. We're about $300 over that, showing a high probability of being able to be positive cash flow. Number 4 on our list, Binghamton, New York with 16. Now remember, we are now, no doubt about it, way over the number in terms of percent return on investment than we were seeing in communities the last time we went through this list. I'm almost certain we weren't above 14% then, and this is 2 points above that, which is a good level of performance. 16.4% in Binghamton, New York. 3-bedroom fair market rent, $1,086, but median sales prices in the first quarter of 2017 were $79,394 with annual wage growth of 7.3%. And again, if we apply our 1% rule, that gives us an expectation of wanting $635 a month in rent, and we're at $1,086. That is a good return on investment. $400 per month, assuming you didn't just buy it outright and you financed it with a 20% down. Number 3 on our list, Augusta, Richmond County, Georgia, South Carolina, at 16.6%. 3-bedroom fair market rent in that area is $1,087. Median sales price in the first quarter of 2017 was $78,500. So actually a little bit less in terms of purchase price, $1 more in rent. So the same kind of return on investment with a little bit more money in your pocket, but there's also the added benefit of having annual wage growth of 8.3%. Now, annual wage growth will give us a clue into what can be the expectations on the part of residents moving forward. They're tending to make more. That tends to indicate a more prosperous community. Oftentimes, that will also feed the idea that you'll be able to raise rents down the future as demand grows. Number 2 on our list, Ogdensburg. It's not Ogdensburg. It's Ogdensburg, Messina, New York. I should really be able to pronounce that, given that everyone who's investing there on average is making 17.1% on their investment. That is freaking awesome. 3-bedroom fair market rent, $1,105. Median sales price in the first quarter of 2017, again, less than the last community we talked about at $77,500. So making more, probably making more like $500 a month easily. Plus, the annual wage growth is 9.5. So it beats out the Augusta, Richmond County area by a full percentage point. Now, number 1 on our list. This one's kind of interesting. I'm not real sure why it's number 1. We'll talk about, just because it's at 17.2%, right? So it's Youngstown, Warren, Boardman, Ohio, Pennsylvania, at 17.2, as I mentioned. 3-bedroom fair market rent on average is $905. Median sales price in the first quarter of 2017 was $63,051. Absolutely the lowest barrier to entry of anything on the list, and it's in number 1. Annual wage growth at 5.3%. And if we apply our 1% rule to that set of numbers, we end up with $504 that we would expect as a minimum rent. $905 would give us a cash flow of $400 on that bad boy, which is nice, but not what we were seeing for the number 2 and number 3 communities on our list. So something to take into account. I get that over the course of the last year, folks have made 17.2%, but if I was betting, I'd probably go more with the number 2 or number 3 levels, simply because A, I'm likely to start off more with more positive cash flow each month, and B, they are seeing higher annual wage growth than we're seeing in the number 1 community. And that tells me that there's a probability that I'm going to see more success in that community. So if you live near any of these, or these are communities you've considered looking at before, jump in, take a look, use the information that I shared with the Rebel Underground to focus in more on specific neighborhoods within these larger areas. If you'd like to get access to that, you can just text the word Rebel Broker to the number 44222. That's the word Rebel Broker, all one word, to the number 44222. Once you've done that, you'll get a response that'll make it clear you're talking to the right folks. Answer a question. You'll be on the list, and the response email that you will get will give you a link to the video. It's a video that you can only access as a member of the Rebel Underground, so check that out. And more videos to come, by the way, to get even to more nitty-gritty detail on analyzing specific properties for how good of an investment they might make. All right, folks, as always, my goal is to give you way more value in terms of stuff to think about or ideas that might, be a seed to help you move forward with your real estate ideas and goals in a way that more than compensates you for the time you've spent listening to this show. Hopefully I've done that today. As always, thanks for listening, and I'll talk to y'all next time.